Yeah, here we go. Welcome to chapter 2 of business finance. And again, you may or may not find, these first two chapter videos of extreme importance, in order to finish your quizzes that are due for chapters 1 and chapters 2. There's some interesting information in here, however, and so take it for what it's worth. As we move forward, I think you'll find that videos, especially those that I've created to help you with problems, I think are going to be extremely valuable. So keep that in mind as we go through. But I offer these just as a little bit of help. They should help you with quizzes, perhaps. So again, we're kind of in a spot here where we're still reviewing accounting, just some of our basic accounting 1, accounting 2 reminders. Got to get that out of there so you guys can see the deal. So we'll talk about the basic financial statements, of course, including the income statement. Statement of retained earnings is just kind of an addition, really, to that income statement, and it says after all is said and done, how much of that do we actually keep in the company, that we can add to the capital base or the net worth or equity of the company. Balance sheet, point in time, right? We take a look at a company as a point in time, assets versus liabilities to equal net worth, and statement of cash flows. That's an important, especially, I think it's especially important if we have a company that's using an accrual method of accounting, which we'll kind of talk about. So the income statement measures profitability over a particular time period. We're used to looking at these for, a quarter, 3 months, or half a year, or a full year, or sometimes even then in longer cases, or shorter as well. So when I was in banking, we literally had a statement of condition, we called it, that was prepared every day, that had a balance sheet and an income statement both on it, and every day, we'd look at that, and helped us to make decisions. Having that kind of information, the availability, that was just unbelievably important to make real-time decisions to make the company a little bit more profitable. So sales are common. Revenue and sales are generally considered to be synonymous. Okay, and then we take off the cost of goods sold, and that gives us a gross profit. And then we talk about subtracting the expenses. Generally, we call those operating expenses. Okay, and that gives us an operating income. From that, then we would deduct things like interest. Okay, and operating income is also oftentimes called the EBIT, or earnings before interest and taxes. And then we deduct those things, right? And that gives us our final net income. Just an example of one there that certainly you can look at. This one even breaks it down on an earnings per share basis, which would be for a corporation. Okay. This is kind of humorous, and it is, but more and more we are finding that sometimes they're finding different ways to account for some different things within corporations. It's kind of interesting. So three primary sources of capital. Now we're talking about the things that actually fund, let's say, the formation of a company, although it can also be an ongoing thing. But these are separate from revenue, right? We're not talking about sales here. We're just talking about things that actually fund the company. Bondholders would be folks that lend money, basically, not basically, absolutely, lend money to a company, a corporation generally. Preferred stockholders receive what are called dividends, okay, as do common shareholders. I would tell you that preferred shares are not real common, and there's been a big trend. I don't know if it's a big trend, but you just don't see much of it anymore. I think the reason for that is from the corporation standpoint, the issuing corporation standpoint, is preferred is kind of a hybrid between a share, a common share, and a bond. Okay, but it's got some of the worst features of each for the issuing corporation. So why do they issue any of them? Because there are some out there. I would tell you that because the things that make it bad for a corporation make it good for an investor. And so sometimes that makes it easier then for the issuing corporation to find investors, right, for that particular product. And so that's why preferred sometimes gets issued. Common shareholders, that's what you and I might have if we want to buy a share of Apple or a share of Google or a share of Microsoft. Gosh, I'm picking on the big tech companies there, maybe ExxonMobil or Glacier Bank. Earnings per share is when we've calculated our earnings, our total earnings, net income. Then we just divide that by the number of shares outstanding, and that gives us an earnings per share. That's a nice number for people to, as investors, to kind of keep track of. You like to see that grow over time. It can grow in a couple of different ways that we'll talk about some of those ways, but can be paid out in dividends or oftentimes retained by the company. Amazon's never paid a dividend. Okay, one of the biggest corporations in the world, and hasn't paid a dividend. Berkshire Hathaway, run by Warren Buffett, same thing, has never ever paid a dividend. Okay, so those monies that they've made have been retained by the company, reinvested. Amazon's still growing, and so they want that to continue to grow, expand into other markets, be it other product markets or maybe geographically. Okay. Berkshire, just because Warren Buffett reinvests that because he's the best investor that's probably ever lived. So, statement of retained earnings, right, indicates what happens to those earnings. So, if we have a net income, and this shows you clearly, right, if we have a net income of 100,000, we pay out dividends of 50,000, then we add 50,000 to our total retained earnings, which gets added to our original capital, right? So we sell stock to, generally speaking, set up a company, if it's a corporation. And then as we have retained earnings, this adds to that equity, or net worth on a book standpoint. Price earnings, and oftentimes called a multiplier, actually, is applied to the earnings per share. This is mainly for investors. Okay, this isn't something that would concern us just every day running around, right? We're not terribly concerned about the price-earnings ratio, but indicates expectations about the future of the company. What I would tell you there is that high-priced earnings numbers tend to be applied to companies that are high growth. Okay, lower-priced earnings numbers tend to apply to companies that are a little more stable in terms of their growth and maybe a little more mature companies. That's not always the case. That's very much an oversimplification, but in that way. And if we get some time here, we'll maybe even take a look at that. So factors that include, the growth of the firm, right? Risk, obviously, the debt-to-equity structure of a firm, which has a lot to do with the risk then in that case, and the dividend payout policy, whether it's retaining to grow, and what we think of the management. Excuse me, I had to sneeze there. So, what's nice about a price-earnings ratio is it is one of those statistics that's kind of an apples-to-apples comparison a little bit. When you're talking about looking at the relative. Maybe your relative interest in investing in a company. If you're a conservative investor, you may shy away from those companies that have high-priced earnings ratios. If you're if you're a growth-oriented investor, those might have more appeal to you. It just gives you a little bit of something that you can compare from company to company, even though those companies may be in very different industries. Exxon versus Apple, for example. And we kind of talked about some of those things. So, and yeah, drops in earnings, and that's why you got to be a little bit careful. If a company had let's say they had a big settlement, Bayer, which owns Roundup, they had a big settlement. They might have one quarter where they got this huge drop off in earnings because they paid that settlement. Their PE ratio gets completely out of whack. Actually, it might be really high in that case because their earnings went down, their price stayed maybe relatively the same, right? And so things can get kind of out of whack, and so you do have to watch for those types of things. These are some examples of price earnings. Again, you'll see, for example, Cisco, which in these are old, and they've changed, but here was Cisco, which was a high growth, tech company back then. They had just the the 2000 dot-com bubble, right? But down to an 8 at this point in time in 2013. And so it's certainly changed over time. Southwest has stayed, relatively high, but recently, a little more recently, again, that's back sometime. But we could sure look up some of those and see, but don't know if we'll have time to do that. Again, but you can kind of see, if I talk about Cisco and Southwest, we're talking about, companies here that were fairly new and high growth have become more mature, right? So that's kind of one of those general things that you'll see. Walmart, same. I mean, to say that it was new in '94 is probably a push. It had been around for a while, but it was still a high-growing company. This is a bit of an aberration. This kind of is too a little bit because we were in the dot-com, this is interesting, the S&P 500 index. So if you look at that, 25, it got up a little higher than that as we went into 1999. This is taking the whole average of the companies, the 500 companies that are listed on the S&P. And we had a huge bubble, they called it, at the end of 1999, 2000. And a lot of the companies were selling for really high valuations or really high price to earnings ratios, which is what you see here, okay? And that bubble burst and then things came down. 2013, the market was kind of stable and things were rolling along. And look at that, the S&P, where are we at right now? We're back up to these kinds of valuations, probably more like this, but we're in that ballpark. And so, a lot of people might say that we're in a little bit of a bubble, but keep in mind, though, too, that some of the earnings from a lot of these companies have been diminished because of the COVID, and yet the value of the companies is still there. People are just waiting for the economy to open back up and knowing that those companies will, again, have pretty good earnings in the future. And so, you can't always look at this as being a fortune teller type of an indicator, but it kind of gives you some ideas of where we're at. So limitations, geez, we kind of bounce around a little bit. I don't know why they do that with the chapter, but limitations of the income statement. I already kind of talked about some of those in day-to-day things or from a quarter to a quarter, and why you can have some big deals, right? And there is some flexibility in the way transactions are reported and those types of things. I can give you a microcosm of that. I had a contractor do a little bit of work for me this past early fall, and didn't get a bill from him, and I finally kind of hit him up and said, "Gee, you ever going to bill me?" And he finally did, and I said, "Now, do you want to get paid this year or next year?" And I was wondering if that's maybe why the bill came so late. And I think I finally got the bill about mid-December, and he got back to me and he says, "Make it next year," and so there's some flexibility. I mean, he wanted to defer that income basically for that year, for the tax purposes, right? You defer paying taxes on that income so you can invest it, put it in some other things for that year, or at least that tax money that you would have otherwise paid in the prior year. So the balance sheet's a point in time, right? And that's what the second one there tells us, right? Items are stated on that or original cost basis rather than current market value, and that can be a big deal, right? And it really depends on the item. Some, for example, land, we buy land, and in this country, if you bought land, let's say 30 years ago, you paid $200 an acre for it, grazing land or some combination of grazing and crop, $200 an acre for it. Now it's worth $500 an acre. Well, it's still on your books at $200 an acre, right? Doesn't matter what it's worth. It's on your books for what you paid for it. Okay. On the other hand, you buy a tractor, right, and it depreciates, and we do depreciate tractors. Okay, so that really creates some anomalies when we talk about the book value. The book value is oftentimes not a very good indicator of what the market value is, maybe, of a company. So things that we have on there, of course, are current assets, and current assets consist of cash, accounts receivable, inventories, things that we can convert to cash within a year, easily convert to cash within a year. And it includes things like marketable securities. Companies have excess cash that they have to invest, and so they put it in marketable securities like government bonds. Excuse me again, not gone, something in the air. And those are temporary investments. And they can put it into some other things. They can be a little bit riskier with it in some cases. And we talked about accounts receivable and inventory. Marketable securities are generally considered to be like cash because you can convert those, literally in seconds if you need to. Prepaid expenses can be considered a current asset. Sometimes it'd be a current asset because it's basically you're not going to prepay something out 3 or 4 years. It's basically going to be in the next year. Investments. Now this gets to be a little bit different. These are considered more of a long-term asset. Okay, it's a long-term commitment of funds, but this gives you some ideas of there's gray areas here, though. If you look at Apple's balance sheet, for example, what you'll see is that they got a decent amount of cash, let's say 50 billion, and they've also got a couple $100 billion probably in investments. Now, if you listen to an analyst talk, they'll tell you that Apple has $250 billion in cash or cash equivalents, and that's kind of true. Okay, they list some of those as investments because Apple intends to hold those for a long time. They don't really intend to convert those, and so they list those. That might have some things to do with how those things are accounted for. There's mark-to-market accounting and some different things like that. Some of those which I truly don't understand, but it can change where a company puts those things on their balance sheet. Plant and equipment is carried at the original cost minus accumulated depreciation, right? Okay, and that's so that we understand that if we bought a piece of equipment, let's say as a farmer you buy a combine, right, but you depreciate it every year, so that we understand that just because we paid $500,000 for it in 2015, in 2020, at least based on our depreciation, it's only worth $250,000 because we've taken down the value because of depreciation. Balance sheet, we get to the total assets, and then we get to liabilities, right? What's owed, and we've got current and long term, just like we do with the assets, or short term or current, same thing. Again, things that are owed within 1 year are considered short term or current. Accounts payable, notes payable. Current portion of long-term debt, CPLTD, that's the payments that you're going to be making on your long-term debt, but just those payments you'll be making in the next year. Expenses, interest expense, certainly. And then you subtract basically the liabilities from the assets, and you end up with shareholders or stockholders' equity. And that is what's of interest to people that are common shareholders, etc., right? And it's also then when you reconcile things, it's the value of the retained earnings plus the capital that is paid in excess of par. It gets to be with the original shares and the par value, and et cetera, and then the common stock value and preferred stock, sort of. There's a balance sheet. We'll be looking at a lot of these. So net worth again is the shareholders' equity minus the preferred stock, and that's why I said that preferred stock is kind of a sort of, again, because preferred stocks is an oddball capital item, an oddball thing. It's really neither a bond nor a stock. It's kind of in between. So the market value, though, when we talk about that, when we say net worth here, that's the book value. And we talk about market value is extremely important. If you look up, again, I'll use Apple. Apple has a market value of nearly $2 trillion. That's what investors think that Apple is worth. Okay, if you looked at Apple's balance sheet, it's probably only a couple $100 billion, if that. There's a big disconnect there, right? Well, what's the disconnect? Well, again, it has some things to do with some of those things on the balance sheet and whatnot and how they're shown. but it's mainly in Apple's case, it's that recognition of their ability to generate revenue into the future. Okay, and so oftentimes there's, especially with these publicly traded companies, there is a huge disconnect between the market value and the book value. Yeah, most values are based when we're talking about the balance sheet, right? It can be troublesome for plant equipment and inventory, but also for real estate. I think those of us that live in farm country here, we understand that Grandpa bought some land that was $50 an acre back then, and that's maybe what it's on our books for. But heck, that might be worth $750 an acre now, right? And so that can make a big difference too, and it can be a limitation of the balance sheet. FASB ruling on disclosure of inflation adjustments. So it's no longer in effect, so it's not something that we really do, but voluntary act. So companies then could, FASB is the Financial Accounting Standards Board, and companies then could make adjustments on values based, or they can make those adjustments based on what happens with inflation. Inflation hasn't been a big deal for the last couple decades, so this isn't a big deal still. Mark to market's still a bit of a big deal. Difference between share values may be due to, right? Again, these are some limitations, the balance sheet, asset valuation. Again, when we talk about real estate, or we talk even about plant and equipment that we've depreciated that may actually have grown in value, and the industry outlook or that individual company's outlook is what makes a huge difference in terms of their earning capacity, growth prospects, et cetera, et cetera. Here we go. Well, Apple was on here. Market price per share was $530, and the book value, per share. If you looked this up now, I would bet that it's even bigger. Google's probably even bigger. Or the difference, is probably even bigger than what it was then. Book value doesn't change a lot. It's going to change as they add some retained earnings, but they both pay out dividends, and so they may not have a ton of retained earnings from year to year. So the book value is going to change a little, but the retained earnings are offset by depreciation of other assets and whatnot. So, but the market values of those companies have skyrocketed. Google's, I think, well over $1 trillion as well. Statement of cash flows. The statement of cash flows is really important because it gives you a better idea, especially maybe those companies that do accrual type of accounting, and you actually see what the effect has on cash, because cash is king, right? You need cash to get things done. Disadvantage of an accrual method is sometimes it doesn't give you that idea. So I think the example here that they give, maybe not on this one, but it has to do with the accounts payable, right? So you may go out as a company and buy a lot of things on account, and that looks good. Now you got those assets there, but if you don't have to pay for them for 90 days, let's say, there's a distortion then in your bookkeeping if you're a cash-based accounting system versus accrual-based accounting system, right? In an accrual-based system, you'd record that expense right then. Okay, on a cash-based system, you don't record that expense until you actually write the check. For smaller companies, the downtown flower shop and whatnot, it may not be a big deal, but bigger companies, it becomes a huge deal. Statement of cash flows, they always break it down. You get cash from operating activity, so the day-to-day, you get sales minus cost of goods sold, use gross profit, right? You've got those cash flows from investing activities, and that's if you sell some property, right? You get cash that comes in, or you buy some property, you got cash that goes out. Those would be investing types of things, and property can be equipment, land, whatever. And then cash flows from financing activities. Did you borrow some money? If you borrow some money, that's positive to cash. Okay. Then you add those together to compute the change in cash flow. And you'll get analysts talking about free cash flow and those types of things, which takes out the financing and maybe some of the investing things. That's just probably more the operational types of cash flows. Yeah, the direct methods, every item, right, is adjusted. The net income starting point, and then you make adjustments to the net income, which is a little bit easier. You know, in banking, a lot of times we just had the down and dirty method of you take net income and add back in depreciation, because for most of our small customers, that kind of would get you to what the cash flow was for that year. Net income, depreciation, yep. Just examples. Here's a comparative balance sheet, cash flow statement. Good to look at. Investing activities, right? Most companies are going to show you that plant and equipment, real estate, those types of things for their investing. You get big cash companies, Apple, Google, Microsoft. Those, you know, they've accumulated so much cash, and while they're paying out dividends, they continue to accumulate it on a big basis, and so they've invested in other things, and typically what they're investing in are maybe long-term bonds and those types of things, either government or other corporations, but they might get some equity investments too, meaning buying stock in other companies. I would guess they don't do that real often. Financial activities can be this: you can issue bonds or you can pay them back, right? You can issue common stock, which would bring in cash, or you can buy back stock, which would send cash out. Again, you can issue preferred stock. You pay the dividends on that, or sometimes that preferred stock expires just like a bond, so then you pay that out. Other types of corporate securities, off the top of my head, I don't really know those. And then payment of cash dividends, of course, has an ultimate effect on that. Sale of firm securities, so that's either stocks or bonds are considered securities. Right, and so those can be a source of funds, and then you can pay dividends or buy back stock. And there's some, you know, Apple has a fairly aggressive buyback program. You know, Microsoft has for years. You know, they've bought back stock to the tune of tens of billions of dollars over the last decade or so. So analysis, things that you look at, right? How are increases in current assets being financed? You know, if you get big increases, and by that, inventory, let's say in accounts receivable, so you're growing like crazy. This happens, and it creates a lot of difficulties with companies. They're growing like crazy. They got inventory coming in, and they got accounts receivable being created, but where's the cash? And that creates problems. So how do you finance those things, right? So associated buildup in current liabilities. Again, that kind of would be the financing of those things. How are you financing long-term assets if you're buying some of those? Are you using cash, which can be a big drain on cash, or are you borrowing? And we always had a saying in banking is you wanted to match the term of the asset, you know, that was being created with the term of the loan. So if you were financing inventory and accounts receivable, which is important, you wanted to make sure that was a short-term loan. On the other hand, if you were financing real estate or equipment, you wanted to make sure those terms kind of matched the life of that asset. You know, equipment maybe having a life of 5 to 7 years, depending on the type of equipment, of course. Oops. Short-term funds may carry long-term needs sometimes, yeah. You know, and some companies are so awash in cash, again, like an Apple. You know, Apple could go out and buy another company that was worth $100 billion, and you wouldn't even hardly notice it on their financial statement, right? Depreciation, we call that a non-cash expense. Okay, you spend you know, $1 million for something, and you depreciate it 10% a year. This is an oversimplified example, but you know, the value of that thing goes down by 100,000 each year, right? But it doesn't cost you anything. You know, you're not writing a check for that. And that write-off, though, helps your taxes, which is kind of nice. So it's not a new source of funds. You know, it doesn't really generate money at all, other than it helps you save a little on the taxes. So, but you add it back in, right? Again, that's kind of the down and dirty way of calculating, and the quick way of calculating the cash flow. Charging of depreciation doesn't influence the funds or the cash movement, right? Comparisons of some cash flows. You guys can look at that. Free cash flows, cash from operating activities, you know, minus capital expenditures, minus dividends. Okay, that gives you an idea. So yeah, you look at the operating. If there are any capital expenditures, yeah, you take a look at that. And by this, when we're talking about capital here, would be again fixed assets, equipment, machinery. Those types of things are considered capital expenditures or long-term items, and then dividends you're paid out to your shareholders. Corporate tax rates, and I had to just change this, the Tax Act of 2016, 2017, whenever that went into effect, became a flat corporate tax rate of 21%. That doesn't include, state and foreign taxes, which could be applicable. A lot of these are multinational corporations, Apple, Google, those ones, they get income from all over the world. And so they pay different tax rates depending on those jurisdictions. This is all subject to change and could be in the very near term. Newly elected President Biden has insisted that he wants to raise taxes on corporations fairly substantially. He'd like to raise them way the heck up to where they used to be, maybe in the 30s. A lot of pushback, and people are saying he might only be able to get it up to 25. Lowering it to 21% like we did just a few years ago made us more competitive in the international arena, but still 21% still one of the higher tax rates among advanced economies. One of the problems we had when we had a lot higher tax rate was companies were relocating income. And there's a lot of different ways that you can do that by setting up subsidiaries in countries that have lower tax rates and really channeling income through those subsidiaries. So there's advantages and disadvantages to higher and lower tax rates. So, oops. Depreciation is a bit of a tax shield, yeah, absolutely. There we go. Kind of a lengthy, review. I hope you got a little bit out of it, and oops, I'll get this thing shut off so you don't have to listen to me anymore. Good luck. Wow, this darn thing, I pressed the wrong button.